James traded in his car last spring and discovered something that genuinely surprised him. He owed more on the loan than the dealer offered for the vehicle. He had made every payment on time for 3 years. He had assumed, reasonably, that paying down a loan steadily meant building equity in the asset attached to it. Instead, he sat across from a finance manager who explained, almost casually, that this situation, owing more than the car was worth, was not unusual at all. It was, in fact, the position close to a third of people trading in vehicles currently find themselves in. That conversation sent James down a research path that turned into this video. 10 statistics about how the average person actually manages money in 2026. Numbers that are individually surprising and collectively reveal something important about the gap between how people think their finances work and how they actually work. Stat 1. Nearly a third of car trade-ins are underwater. The number that started this whole video. Approximately 27% of vehicle trade-ins currently carry negative equity, meaning the owner owes more on the loan than the car is actually worth. The average gap in these situations runs close to $6,700. Among the worst cases, nearly a third of underwater trade-ins carry a gap between $5,000 and $10,000. This situation is being driven by a combination of factors compounding simultaneously. Loan terms have stretched dramatically. 84 and even 96-month auto loans are no longer unusual, meaning buyers are paying down principal far more slowly relative to the vehicle's depreciation curve. Many of these loans originated during a period when vehicle prices were inflated by supply disruptions, meaning the original loan amount was already higher than the vehicle's long-term value would support. Depreciation, meanwhile, continues at its normal pace regardless of what the loan terms assume. The practical lesson? Buying a vehicle 3 to 5 years old lets someone else absorb the steepest depreciation curve. Treating a car as transportation rather than as identity removes the pressure to finance something larger than necessary. And the 20% down, 4 to 5 year loan, 10% of income guideline remains one of the more reliable frameworks for keeping a vehicle purchase from quietly becoming a long-term financial liability. Stat 2. Buy now, pay later debt is quietly accumulating. The average user of buy now, pay later services currently carries an outstanding balance in the $700 range across active installment plans. The mechanism is straightforward, and the psychology behind it is well understood. Splitting a purchase into smaller payments reduces the immediate discomfort of spending, which research consistently shows increases the likelihood of purchases happening at all. The data on how this plays out is not encouraging. Close to a quarter of users report being late on at least one payment within a given year. Nearly 40% of regular users report some level of regret about using these services. And contrary to the assumption that this is primarily a tool for lower-income consumers managing tight budgets, a meaningful share of usage comes from households earning well above the national median, suggesting this is less about necessity and more about a structural nudge toward overspending that affects nearly every income bracket. The lesson is straightforward, even if it requires discipline to apply. If a purchase requires splitting into installments to feel affordable, that is useful information about whether it should be made at all. Interest-free does not mean cost-free. It is still debt, and debt that fragments spending into smaller, less noticeable pieces tends to produce more total spending, not less. Stat 3. Trillions sit in accounts earning next to nothing. Americans currently hold more than $18 trillion across bank accounts. The overwhelming majority of that money sits in standard accounts earning interest rates close to zero, while high-yield savings accounts offering meaningfully better returns remain dramatically underused. The vast majority of account holders have never opened one. Run the simple comparison. $5,000 sitting in a standard savings account earning roughly 0.4% generates around $20 annually. The same $5,000 in a high-yield account, earning closer to 4%, generates nearly $200, a difference that requires zero additional effort, zero additional risk, and exists purely because which institution is holding the deposit. This is, in aggregate, one of the largest and most easily corrected sources of lost wealth in the entire personal finance landscape. Moving an emergency fund or any meaningful cash reserve into a high-yield account takes roughly 15 minutes online and produces an immediate, guaranteed, risk-free improvement in returns. Stat 4. Most Americans cannot cover a $1,000 emergency. A consistent and uncomfortable finding across multiple recent surveys. Approximately 60% of Americans could not cover an unexpected $1,000 expense using savings alone. When faced with this kind of expense, roughly a quarter would turn to a credit card to cover it, converting a one-time emergency into ongoing debt at double-digit interest. The generational breakdown adds important context. Among the youngest working adults, more than a third report having no emergency savings whatsoever. Across the next several generational cohorts, a significant share have some savings, but not enough to cover even 3 months of essential expenses. The practical response is not complicated, even if building the habit takes time. Any amount saved, even small and inconsistent at first, begins building the foundation that prevents a single bad week from becoming a multi-year financial setback. An emergency fund kept separate from primary checking, specifically to reduce the temptation to treat it as available spending money, tends to survive longer and serve its actual purpose more reliably than one mixed in with day-to-day funds. Stat 5. The gap between median and typical high-income savings is larger than most people assume. The median bank account balance across American households currently sits around $8,000. Age plays an obvious role. Older households tend to have accumulated more, but income matters considerably more than age alone suggests. Among households earning above roughly $150,000 annually, the median account balance is closer to $34,000. This creates an easy trap in self-assessment. Someone with $12,000 saved might reasonably feel ahead of the curve compared to the broad national median of $8,000. But measured against their actual income bracket, the same balance might represent meaningfully less progress than peers earning similarly are making. The honest takeaway here is twofold. First, idle cash beyond what is needed for genuine liquidity should be working, invested, or at minimum earning meaningful interest, not sitting stagnant. Second, broad national statistics are a useful baseline, but a poor personal benchmark. The comparison that actually matters is against your own specific income, expenses, and goals, not an average that may have very little relationship to your actual circumstances. Stat 6. A surprising share of retirement contributions sit uninvested. This statistic genuinely startles most people who hear it for the first time. A meaningful percentage of individuals contributing to retirement accounts have money sitting entirely in cash within those accounts, never actually invested in anything that grows. There are two common paths into this situation. The first happens when someone opens an IRA, contributes consistently, and assumes the contributions are automatically invested, only to discover years later that the money has been sitting as uninvested cash the entire time, missing out on every percentage point of market growth that period might have offered. The second happens during account rollovers, when funds moved from an employer-sponsored plan into an individual account get converted to cash during the transfer and require an active, separate decision to reinvest, a step that research suggests a majority of people are not fully aware they need to take. The lesson is simple and worth acting on immediately if it applies. Check what your retirement contributions are actually invested in right now. Confirm the allocation matches your intended strategy, and after any account rollover, specifically verify that the transferred funds were reinvested rather than left sitting as cash. Never assume, always confirm. Stat 7. The market's volatility is normal, not exceptional. Since 1930, the S&P 500 has finished the year down between 10 and 20% in roughly 38% of those years, and down more than 20% in about 16% of them. Put plainly, meaningful annual declines are not rare disruptions to an otherwise smooth upward trend. They are a routine and expected feature of how markets actually behave over time. Despite that volatility, long-term average annual returns have historically landed in the 8 to 10% range across extended holding periods. The data on missing the market's best days is particularly striking. An investor who missed only the 10 best trading days across a multi-decade period would forfeit more than half of their total potential returns. Missing the best 20 or 30 days produces even more dramatic reductions. The conclusion that follows is one of the most consistently validated principles in long-term investing. Staying invested through volatility, rather than attempting to predict and avoid downturns, has historically been the more reliable path to capturing long-term market returns. Broad index investing remains one of the simplest tools for participating in that long-term growth without requiring active prediction or constant management. Stat 8. The age of first-time homebuyers has climbed dramatically. The median age of a first-time homebuyer currently sits around 38. In the early 1990s, that figure was closer to 28, a full decade younger. Housing affordability has shifted substantially over the intervening decades, and a growing number of people are choosing to rent for longer, sometimes investing the difference rather than directing it toward a home purchase, partly because renting offers flexibility that ownership does not, and partly because the math on ownership has become considerably less favorable in many markets. Current data suggests that the income required to comfortably afford a median-priced home now runs well above the median household income in many regions, a gap that did not exist to the same degree a decade ago. For anyone considering a home purchase, the practical guidance worth keeping in mind includes planning to stay in the property for at least 5 to 10 years to make the transaction costs worthwhile. Recognizing that homeownership is one path to building wealth rather than the only path, and running the full cost picture, including maintenance, insurance, taxes, and opportunity cost, rather than evaluating the decision on the mortgage payment alone. Stat 9. The net worth required to reach the top 10% is higher than most people assume. Current estimates place the net worth threshold for the top 10% of American households north of $1.5 million, adjusted for recent inflation. This number surprises many people, partly because it is considerably higher than commonly assumed, and partly because it highlights an important distinction. Income and net worth are related but distinct measures, and a high income does not automatically translate into a correspondingly high net worth. Someone earning in the top 10% of income can still fail to reach the top 10% of net worth if spending habits consistently absorb the income advantage. Net worth reflects not what you earn, but what you keep and grow, making it, in many respects, a more honest reflection of financial behavior than income alone. Trapping net worth periodically, not obsessively, but consistently, tends to reinforce behaviors that grow it, simply through the visibility the tracking provides. Stat 10. Savings rate matters more than return rate, especially early on. The final statistic is the one with the most actionable insight buried inside it. Consider two people, both earning the same income, both trying to reach the same savings target. One saves a modest percentage of income but earns a low return on it. The other saves half as much but earns a meaningfully higher return. Run the actual math across realistic time frames, and the counterintuitive result holds consistently. The person prioritizing a higher savings rate reaches the target meaningfully faster than the person relying primarily on a higher return rate, even when that return rate is many multiples higher. Early in a financial journey, before compounding has had time to meaningfully accelerate, the amount being set aside matters more than the rate it is earning. The implication is genuinely useful and often overlooked in investing conversations that focus heavily on return optimization. Increasing a savings rate by even a few percentage points, particularly early on, tends to move the needle on long-term wealth more reliably than chasing marginally higher investment returns. Both matter eventually, but for anyone just starting, the savings rate is the lever within more direct and immediate control. James's underwater car trade-in led him through all 10 of these statistics, and what struck him most by the end was not any single number, it was the pattern connecting all of them. Almost every one of these statistics describes a gap between what people assume is happening with their money and what is actually happening. The car loan that felt like it was building equity, the savings account that felt like it was earning interest, the retirement contribution that felt like it was invested. The assumption in every case was reasonable. It was also, in every case, wrong. The fix across all 10 statistics is the same. Check. Verify the actual numbers rather than the assumed ones. Confirm where money is actually sitting, what it is actually earning, and what it is actually doing on your behalf. The gap between assumption and reality is where most quiet financial damage happens, and it is also, conveniently, one of the easiest gaps to close once you know to look for it.